For more on what the Fed will do and what it means for opportunities in credit, we're joined now by Bruce Richards of Marathon Asset Management. It's good to see you. Welcome back.
Good to see you, Scott.
Well, that
Thank
was
you.
timely for our conversation. What do you think they're going to do next week?
Cut.
By how much?
They're going to cut by 25 basis points. 50's off the table, 25, and it's a lock, 100% probability priced in the market that they'll cut for each of the next 3 times this year, which is bringing rates down 75 basis points.
Why do you think 50's off the table? And do you think the market thinks that? Because, we're hitting record highs again. You don't think that's in anticipation of maybe 50?
I think the market may be a little disappointed if they don't see 50. It doesn't matter. They're only going 25. It's only justified to go 25. Inflation, quietly, the Fed is saying implicitly 2% is their inflation goal, and we're looking the other way, and we're going to accept 3 because inflation's firmly set at 3, and yet they're going to cut, and they're going to cut because they're more focused on jobs, and job data is weak. But the job data being weak doesn't mean that the economy is going to be weak. There's very little to no risk of recession or stagflation because this quarter we're going to see a 3% GDP print, according to GDP Now. Last quarter was 3.3%, so a 2% growth this year, and inflation at 3%. I believe they bring Fed funds all the way down to 3% over time, but cut in every one of the next successive meetings is what's in the books.
Why are you so sure about the no stagflation? Because that seems to be a principal risk in this whole conversation.
True, but the Fed is cutting with markets at all-time highs, and the equity markets are telling me growth because if there's stagflation or recession, equity markets are going down, not up. Credit spreads are also telling me, and they are, at 300 in the high yield market, that there's no recession coming and no stagflation coming. And so the markets are telling you this. I don't deny what the markets are saying. And what we see is the big, beautiful bill is going to be a huge stim package. In addition to the productivity gains from AI, in addition to the $1 trillion that's going to be spent in data centers, there's this big, beautiful bill which is going to accelerate a lot of CapEx spending, a lot of R&D, because of an instant day one tax write-off, and companies take a few months, maybe 6 months or a year to make those plans to spend it, but that's the next leg that's coming.
Is this one of the last moments for your best opportunities, right? You follow me? Your last moments for the best opportunities in credit, given the Fed's going to start cutting?
Well, the public markets, spreads have tightened. Rates have come down. They're performing exceptionally well. But what we see is a lot of new issuance. And so there's a lot of ability to gain alpha from investing in some of these new issues. They're doing very, very well. So not even close. It's an opportunity as opposed to a last stand. On the private credit side, there's 3 big legs to the stool in private credit: direct lending, asset-based lending, opportunist credit. In direct lending, it's the most prolific period of time that we've seen ever at our firm. In the last week, we've approved 7 deals through investment committee, and this is direct lending for LBO shops, so private equity spending money, and you're going to see these deals come in the next month to 2 months when they close, and this is the busiest activity that we've ever seen at Marathon. We do 1 to 2 deals a week that come through.
And lower interest rates aren't going to impact the return on that?
Lower interest rates going to help private equity get to a place where they can do more and more deals, more refinancings, more new issue activity. It's going to spur transactions as opposed to hurt anything. And what we see is the back lever coming down where banks will finance us. And so those leverage facility rates coming down, so allowing us to earn a high rate of return on these widespread private credit loans.
What's your favorite part of the credit space today as you sit here?
Well, I love what I'm seeing in direct lending. But I got to tell you, what we're seeing in asset-based lending is absolutely prolific. Financing property, plant, equipment, what's happening in the AI world, financing hard assets, and doing it at LTV attachment points that are very, very attractive and making tremendous rates of return. Risk mitigating because we're lending at 60% LTVs, so we have a 40% margin of safety, yet we're making the same type of spread that we're making in direct lending and the same type of returns, which are low to mid-teens. And so I like everything I see in direct lending, and compared to public credit, which is also a very good investment, it's now a 500 basis point incremental spread pickup for us in our investment program.
All right.